Credit Suisse: How Greed Destroyed a 167-Year Banking Giant. Switzerland's second-largest bank collapsed spectacularly after decades of money laundering, tax evasion, and helping dictators hide billions. Here's how executive greed brought down a financial empire that survived 2 world wars, only to be destroyed by its own insatiable appetite for dirty money. Credit Suisse wasn't always a criminal enterprise masquerading as a respectable bank. Founded in 1856 to finance Switzerland's railway expansion, it grew into one of Europe's most prestigious financial institutions, managing over $1.5 trillion in assets by 2021. But beneath the polished marble lobbies and Swiss precision lay a culture of willful blindness, where profits mattered more than principles, and no client was too dirty if their money was clean enough. The bank's transformation from conservative Swiss institution to global money laundering operation didn't happen overnight. It was the result of systematic decisions by executives who prioritized short-term gains over long-term reputation, turning Credit Suisse into what prosecutors would later call a criminal organization that facilitated tax evasion on an industrial scale. The 2008 financial crisis should have been a wake-up call, but instead, it marked the beginning of Credit Suisse's most reckless period, as executives doubled down on high-risk, high-reward strategies that would ultimately prove catastrophic. The scope of Credit Suisse's criminal activities was staggering in both scale and audacity. Between 2008 and 2014 alone, the bank helped over 22,000 American clients evade taxes on more than $10 billion in hidden assets, operating what federal prosecutors described as a conspiracy to help U.S. taxpayers evade taxes. Bank employees used coded language, encrypted communications, and elaborate schemes to hide client identities from authorities. They would meet American clients at Swiss consulates, luxury hotels, and even airport bathrooms to avoid detection. One particularly brazen scheme involved Credit Suisse bankers traveling to the United States with client account information hidden in their underwear to avoid airport security scanners. The bank maintained over 10,000 undeclared accounts for American citizens, generating hundreds of millions in fees while helping clients dodge billions in taxes. Swiss banking secrecy laws provided the perfect cover for these operations, but Credit Suisse went far beyond traditional privacy protection, actively coaching clients on how to lie to tax authorities and providing fake documentation to support false declarations. The bank's client list read like a who's who of international criminals, dictators, and corrupt officials. Credit Suisse managed accounts for some of the world's most notorious figures, including former Ukrainian President Viktor Yanukovych, who stole billions from his country's treasury, and associates of Vladimir Putin who used the bank to launder money through shell companies. The bank held over $230 million for the family of Hosni Mubarak, Egypt's former dictator, even after his assets were frozen by international sanctions. Indonesian dictator Suharto's family maintained accounts worth hundreds of millions at Credit Suisse, money that prosecutors alleged was stolen from the Indonesian people during his 32-year reign of terror. The bank also served Jordan's King Abdullah, helping him secretly purchase luxury properties in London and California worth over $100 million while his country struggled with poverty and debt. Perhaps most shocking was Credit Suisse's relationship with convicted human traffickers, drug cartels, and arms dealers, including members of the Bulgarian mafia who used the bank to launder proceeds from cocaine trafficking and weapons smuggling. Internal documents leaked in 2022 revealed the stunning extent of Credit Suisse's willful blindness to criminal activity. The Swiss Secrets leak, based on data from over 18,000 bank accounts, showed that Credit Suisse knowingly maintained relationships with clients flagged by their own compliance systems as high-risk criminals. The bank's internal risk assessments identified clients involved in torture, drug trafficking, money laundering, and corruption, yet these relationships continued for years, generating massive fees for the institution. One internal memo revealed that compliance officers raised red flags about suspicious transactions totaling over $8 billion, but senior executives overruled these concerns to preserve lucrative client relationships. The bank's own employees described a culture where willful blindness wasn't just tolerated but rewarded, with relationship managers receiving bonuses based on assets under management regardless of their criminal origins. Credit Suisse's compliance department was systematically undermined by senior management, with staff instructed to look the other way when dealing with politically exposed persons and high-net-worth clients from countries with weak rule of law. The tobacco financing scandal exemplified Credit Suisse's moral bankruptcy and disregard for global health initiatives. Between 2003 and 2013, the bank provided over $2 billion in financing to tobacco companies, including secret loans that violated international anti-smoking agreements. Credit Suisse helped tobacco giants Philip Morris and British American Tobacco circumvent regulations designed to reduce smoking in developing countries, providing funding for marketing campaigns that specifically targeted children and vulnerable populations. The bank structured these deals through complex derivative instruments and offshore entities to hide the tobacco company's involvement from health regulators and anti-smoking advocates. Internal emails showed that Credit Suisse executives knew their financing was being used to undermine public health initiatives, including WHO anti-smoking campaigns in Africa and Asia. One particularly damning internal document referred to anti-smoking regulations as business opportunities that could be exploited through creative financing structures. The bank earned over $200 million in fees from tobacco financing while helping companies market cigarettes to populations with limited access to health care, contributing to millions of preventable deaths worldwide. The Archegos Capital collapse in March 2021 exposed Credit Suisse's catastrophic risk management failures and marked the beginning of its final downward spiral. Archegos, a family office run by former Tiger Asia manager Bill Huang, had built massive leveraged positions in media and technology stocks, using total return swaps that kept their holdings hidden from regulators. Credit Suisse provided Archegos with leverage ratios exceeding 20-1, meaning the fund controlled over $100 billion in positions with just $5 billion in capital. When several of Archegos's concentrated stock positions began falling, the fund faced massive margin calls that it couldn't meet. The subsequent forced liquidation of Archegos's positions caused Credit Suisse to lose $5.5 billion in a matter of days, wiping out years of profits and devastating the bank's capital position. Internal investigations revealed that Credit Suisse's risk management systems had failed catastrophically, with different departments unaware of the bank's total exposure to Archegos. The bank's prime brokerage division had ignored multiple red flags about Archegos's concentrated positions and excessive leverage, prioritizing fee income over prudent risk management. Other banks, including Goldman Sachs and Morgan Stanley, managed to exit their Archegos positions with minimal losses, highlighting Credit Suisse's incompetent execution during the crisis. The Greensill Capital scandal, running parallel to Archegos, further demonstrated Credit Suisse's broken risk culture and management failures. Greensill, a supply chain finance company founded by Australian financier Lex Greensill, promised revolutionary improvements to working capital management through innovative factoring arrangements. Credit Suisse created 4 investment funds that funneled over $10 billion into Greensill's financing schemes, marketing these products to wealthy clients as low-risk investments. However, Greensill's business model was built on fraudulent invoices, circular financing arrangements, and loans to companies that didn't exist. The funds purchased fake invoices from shell companies created by Greensill, generating artificial profits while the underlying assets were worthless. When Greensill collapsed in March 2021, investors faced total losses on their investments, with Credit Suisse unable to recover more than $7 billion in client money. The bank's due diligence on Greensill had been virtually non-existent, with investment committees approving billions in funding based on presentations that contained fundamental misrepresentations about the underlying assets. Swiss financial regulators later determined that Credit Suisse had violated multiple banking laws in its promotion of Greensill funds, including failures to properly assess risks and misleading disclosures to investors. The cumulative weight of scandals, losses, and regulatory failures created a crisis of confidence that proved insurmountable for Credit Suisse's leadership. By late 2022, the bank faced a perfect storm of challenges: massive legal settlements totaling over $12 billion, client outflows exceeding $130 billion as wealthy depositors fled to competitors, and credit default swap spreads indicating imminent bankruptcy. Credit Suisse's stock price collapsed from over $80 in 2007 to less than $2 by March 2023, destroying over 95% of shareholder value and making the bank effectively worthless. The Saudi National Bank, Credit Suisse's largest shareholder with a 9.88% stake, publicly refused to provide additional capital, citing regulatory restrictions but effectively signaling the end of investor confidence. Credit Suisse's bonds traded at distressed levels, with some securities falling below 25 cents on the dollar as markets priced in the likelihood of default. The bank's attempts to raise capital through rights offerings and asset sales failed catastrophically, with investors refusing to provide funding to an institution they viewed as terminally compromised. Swiss authorities, recognizing that Credit Suisse's collapse could trigger a global financial crisis, arranged an emergency sale to rival UBS for just $3.25 billion, a fraction of the bank's book value and a devastating loss for shareholders, bondholders, and employees. The forced merger with UBS in March 2023 marked the ignominious end of Credit Suisse as an independent institution, concluding 167 years of banking history with a fire sale that shocked global markets. The Swiss government orchestrated the weekend rescue after Credit Suisse's liquidity position deteriorated so rapidly that the bank faced potential collapse within days. UBS acquired its former rival for approximately $0.76 per share, compared to Credit Suisse's book value of over $8 per share, representing one of the largest wealth destructions in banking history. The deal included unprecedented government guarantees, with Swiss authorities agreeing to cover up to $9 billion in potential losses on Credit Suisse's toxic assets. Perhaps most controversially, Swiss regulators ordered the complete write-down of Credit Suisse's additional Tier 1 bonds worth $17 billion, wiping out bondholders who traditionally rank above shareholders in bankruptcy proceedings. This decision sent shockwaves through global credit markets and raised serious questions about the safety of bank bonds worldwide. The merger eliminated over 36,000 jobs globally as UBS moved to integrate Credit Suisse's operations and eliminate redundancies. For Swiss banking, the collapse represented a national humiliation, destroying one of the country's most prestigious financial institutions and calling into question Switzerland's reputation as a global banking center. The Credit Suisse collapse stands as a cautionary tale about the dangers of prioritizing short-term profits over long-term sustainability, demonstrating how executive greed and regulatory capture can destroy even the most established financial institutions. The bank's executives, who earned hundreds of millions in compensation while driving the institution toward bankruptcy, faced no meaningful consequences for their failures. Former CEO Brady Dugan, who presided over many of Credit Suisse's worst scandals, left the bank in 2015 with a compensation package worth over $150 million. His successor, Tidjane Thiam, departed in 2020 following a spying scandal involving UBS executives, but retained millions in unvested stock awards despite his role in the Archegos and Greensill debacles. The bank's board of directors, dominated by industry insiders with conflicts of interest, consistently failed to provide meaningful oversight, rubber-stamping management decisions that ultimately proved catastrophic. Swiss financial regulators, despite numerous warning signs and whistleblower complaints, failed to take decisive action until the bank's collapse was inevitable, raising serious questions about regulatory capture and the effectiveness of Swiss banking supervision. The Credit Suisse saga reveals how modern banking has evolved into a system where profits are privatized while losses are socialized, with taxpayers and depositors bearing the costs of executive recklessness. As UBS works to integrate Credit Suisse's operations and toxic assets, the broader banking industry continues to grapple with the systemic risks created by institutions that consider themselves too big to fail, setting the stage for future crises that may prove even more devastating than Credit Suisse's spectacular collapse.